Welcome to The Explainer. I am so incredibly pumped you're tuning in today because today we are taking complete control of your financial future. We're cutting through all the noise, the complex jargon, and the overwhelming financial news, and we're just going to focus purely on the core principles of building wealth. If you've ever felt intimidated by investing, or if you're sitting there feeling like you just don't have enough money to even start, you are in the exact right place. We're going to break down everything you need to know to get rolling step by step. So let me start by asking you a question, and honestly, the answer might blow your mind. Is your savings account actually making you poorer? Think about it. Most of us are taught from a super young age that the smartest, safest thing you can possibly do with your money is just lock it away in a savings account at the local bank. But here is the crazy, counterintuitive truth. Playing it safe by holding all your cash in a regular bank account is actively shrinking your wealth every single day. If you want your money to work for you instead of working for the bank, we really have to rethink what safety actually means. Okay, let's dive into this because this number right here, this is the silent thief in the night, 2 to 3%. That's the average annual rate of inflation. Basically, if your money is just sitting perfectly still in a checking or savings account earning practically zero interest, it is quietly losing its purchasing power every single year. That $100 you have today will literally buy you less stuff a year from now. Section 1, the magic antidote, compound interest. So if hoarding your cash under the metaphorical mattress means you're slowly going broke, how do we fight back? Well, it's all about compound interest. Put simply, it's earning returns on your initial investment, and then, here's the real kicker, earning returns on those returns over time. It creates this massive snowball effect. Year 1, your money makes a little money. Year 2, your initial money plus that new money makes even more money. This is the absolute secret to how wealth is built quietly over decades. You don't need a massive salary, and you don't even need to constantly add huge sums of new money. You literally just need to let the math do its thing. Now, what's really interesting about this slide is seeing that math in action. Let's say you invest just $5,000. One time, no extra contributions, just $5,000. If that money earns an average return of 8%, look at that middle bar. In 10 years, it has more than doubled to around $11,000. But look at year 20. That exact same original $5,000 has basically quintupled to around $24,000, entirely on its own. That is the absolute magic of earning returns on your returns, no extra heavy lifting required. Section 2, core rules for wealth creation. Now, to actually capture those compounding returns, we need a few guardrails. And the most crucial rule to understand is the contrast you see right here. So many beginners think investing is about staring at stock tickers all day, trying to predict the exact perfect minute to buy low and sell high. That's called timing the market, and historically, it's a fantastic way to lose your shirt. What actually works is time in the market, consistent, long-term holding. Patience always beats trying to gamble on daily market movements. Building on that patience, you need to keep these 3 remaining rules in mind. First, understand that higher returns always come with higher risk. Stocks can go up a lot, but they can definitely drop too. Second, diversification is your absolute best friend. You should never put all your eggs into just one stock. Spreading your money out is what protects you. And third, oh man, this is a big one. Keep your fees as low as possible. You might think a tiny 1% management fee is nothing, right? But over a lifetime of compounding, that 1% can literally cost you tens of thousands of dollars. Keep your money in your own pocket. Section 3, the best beginner investments. All right, with those rules established, what should you actually buy? If you look online, the amount of financial jargon is totally overwhelming. But we're going to cut right through all of that. My top recommendation for beginners, hands down, is low-cost index funds and ETFs, specifically ones that track the S&P 500. When you buy just a single share, you are getting instant ownership in 500 of the biggest, most successful companies in America all at once. It technically makes you a mini mogul. It's super cheap to buy, it's incredibly diversified right out of the gate, and best of all, it entirely avoids the stress of chasing some hot crypto tip your buddy told you about. And why the S&P 500? Well, because of this range right here, 7 to 10%. Historically, over the long haul, the S&P 500 has delivered average annual returns right in this 7 to 10% sweet spot. Sure, there are going to be down years, and there will be massive up years, but that historical average is what provides the steady, powerful growth potential that fuels that compound interest snowball we looked at earlier. Moving right along to avoiding major beginner mistakes. Now, even with index funds, the market isn't always a totally smooth ride, so you've got to manage risk based on your age, and this brilliantly illustrates a simple rule of thumb. If you're under 40 years old, you have time on your side to weather any market storms. So you should have 80 to 100% of your portfolio in stocks, like that S&P 500 fund. The remaining 0 to 20% can sit in bonds, which just give you a bit more stability. As you get closer to retirement, you simply adjust this ratio, adding a few more bonds for safety. It's a brilliantly simple set and forget framework. But listen, even with the perfect allocation, beginners still fall into these emotional traps. Panic selling during a market crash is absolutely the worst thing you can do because you're literally just locking in your losses. Chasing hot trends, that usually means you're buying in way too late when the price is already totally inflated. And as we discussed, paying high fees silently drains your wealth. The remedy for all of this? Just stay calm, stay invested, and keep adding money regardless of what the news says the market is doing today. Which brings us to your 3-step action plan. All right, we've covered the why, the what, and the pitfalls to avoid. Now it's time to get practical. We're moving into a clear, completely unintimidating roadmap so you can actually put this knowledge to use today. Here is the exact sequence. Step 1. Before you invest a single dime, build a small emergency fund. You want 3 to 6 months of living expenses sitting safely in a high-yield savings account. This ensures you never have to sell your investments in a panic just to pay for a broken water heater. Step 2 is opening the right investment accounts. And step 3 is to invest automatically every single month. By setting up an automatic $50 or $100 transfer, you're using a strategy called dollar cost averaging, which completely removes all human emotion from the process. Let's move to step 2 and see how this builds, because choosing your accounts is absolutely critical. If your job offers a 401k with a company match, start right there. Contribute at least enough to get the full match, because guys, that is literally free money. Next, prioritize a Roth IRA. You put money in after taxes, but then it grows completely tax-free forever. It's awesome. Finally, a standard brokerage account at places like Vanguard, Fidelity, or Schwab is fantastic because they offer zero commission trading and really great beginner tools. And finally, the 7-day checklist. So you have the overarching strategy. Let's narrow it down to the immediate future with a final set of homework tasks to really solidify everything you've learned here today. Honestly, take a screenshot of this right now. Over the next 7 days, I want you to do these 4 things. 1. Look at your budget and calculate exactly how much you can realistically afford to invest every month. 2. Go online and open an account at one of those major brokers today. 3. Take the plunge and invest your first dollars into a low-cost S&P 500 index fund. And 4. Set up those automatic transfers. Remember, investing isn't about getting rich overnight. It's about building wealth quietly and steadily over time. Which brings us to the ultimate question you really have to ask yourself right now. Are you going to let your money quietly disappear to inflation, or are you ready to finally put it to work? The most important thing you can possibly do for your financial future is to simply start today. Harness the power of compounding and let time do the heavy lifting. Thank you so much for joining me for this explainer. I really hope this gave you the clarity and the confidence to take that first step. Now go make your money work for you, and I'll see you next time.